Should you buy IPO stocks? Let's find out. So before we dive in, I'd like to quickly just define the difference between an IPO and DPO. So IPO is initial public offer and DPO is direct public offer. Now with an IPO, you usually go through a large investment bank. That takes a little more time. There's more fees, underwriting fees, and it's a more common practice. But you also have DPOs, which is more direct to the public, and you avoid those large underwriting fees, so it saves companies some money. At the end of the day, we don't really care what the difference is. What we care about is what happens after the stock goes public. So here's the big thing to think about. Just because you can go public doesn't mean you should go public. What do I mean by that? So to back up a second, a lot of these businesses out there that are thinking about going public, they're running into a fundraising problem. And what that means is venture capitalists have lost interest, banks are no longer providing loans, and even private equity is laughing them out the door. So what do these businesses do? They go to people like us, and most retail investors, they don't know the difference between a good stock and a bad stock. So what happens is there's all this hype, the stock goes public, we put our money in the market, and then the first earnings report comes out. That's that quarterly report where you have your estimate and then you have your reported. And what happens is, in most cases with these new businesses that are going to the market, whether it's an IPO or DPO, they miss the estimate and the share price falls off a cliff. And a lot of people like you and I lose money. Now, what happens to the founder and the investors? In some cases, they like to see the stock go public because they get to pocket a bunch of money at that event, regardless what happens at that next earnings report. They don't like, okay, so I take all my money when it goes public and now I have to give it back. Like that doesn't happen. The people who are left with the short end of the stick, pretty much you and I, and the large institutions that invest in these companies after it goes public. So here's what we need to do when a stock goes public. Is you need to wait. And I like to wait at least 4 quarters because I want to see consistency with beating earnings expectations. So you have your estimate, you want to see reported beat every quarter for 4 quarters in a row. Of course, most IPOs, they're, like I said, raising money and they're not going to beat expectations or estimates, but in some cases they do. But just in case, this is why I recommend sit on the sidelines, let these institutions put their money in first. And if a company is beating estimates quarter over quarter for over a year, then you could say, you know what, this is a strong company. I might consider investing. But as always, I always say double check, go into Tykr, see if it's on sale, and then maybe make a buy decision from there. If you like this video, hit that like button. If you want to see more like it, hit that subscribe button. And if you want to learn more about investing, especially IPO stocks, go ahead and check out Tykr.com. See you in the next video. Bye for now.